Hello, everybody. It's Ed Yardeni, and today is actually Sunday evening, Sunday night. It's 11 p.m., and I've had to record our session here with everything that's going on. I would have liked to do it live on Monday, but I got called for jury duty, so we'll see how that goes tomorrow, Monday morning, whether they tell me to stay and be a juror or whether they'll let me off. So we'll see. I'm going to try to postpone it to July. So we'll see if they'll let me do it. The problem is I've already postponed it once. So it's Call of Duty. We'll see how that goes. But the good news is that we've had really nice weather here. The bad news is everything else has just kind of gone berserk. A lot of chaos in the geopolitical realm. Over the past few months, when people asked me where the risks lie, and I thought it would be in the geopolitical realm, I just didn't quite expect that it would turn out the way it's going right now. Well, when the war broke out a little over a week ago on Saturday, my initial reaction was that with the Israelis and the U.S., the Americans able to decapitate the regime within the first hour of the war, that might suggest that these two allies were or had everything under control, everything fully planned, and it might turn out to be a fairly short war. But then by Tuesday, I was writing about the fog of war, Tuesday of last week. And you never know about wars. And even no matter how well planned it is, it doesn't necessarily go well. I know there's some sayings about when the cannons are firing or when there's blood in the street. But I've been arguing that geopolitical crises are in fact buying opportunities. But then again, much depends on how this war plays out. And I think there was a lot of optimism that with the U.S. and Israel basically running Iran ragged, no longer, they didn't have any defenses really. And the air war was going spectacularly well. The problem is military historians have often pointed out that air campaigns can't completely finish off an enemy, that air campaigns don't really win wars. You have to have boots on the ground. And President Trump has talked about the possibility of boots on the ground, but he's also said that that won't happen until the Iranians are so beat up that the risks to American troops are low. But that's that's kind of a naive notion about wars. And the problems we have with Iran is a terrorist state. It's been a terrorist state since its inception for the past 47 years. It's been at war with us and Israel for the past 47 years. It's exported and funded a lot of terrorism around the world. It's got its proxies. So beheading them isn't necessarily going to do the trick the way it might in another country. I think people were kind of hoping that the model was Venezuela, that you get Maduro and then everybody else is cooperating and working in America's interests. In the case of Iran, they've got the Islamic Revolutionary Guard Corps, the Iran Revolutionary Guard Corps, which was really created almost immediately when the theocracy was created by the mullahs 47 years ago to protect the theocracy, even from the army. It's the IRCG. Let me see if I got that right. Yeah, I think it's the IRCG was created. They were created in an effort to protect the theocracy, even from the army, from internal threats as well as external. And they are a terrorist organization. The United States labeled them a few years ago as a terrorist organization. Terror is what they do. That's their profession. They own large parts of Iran's economy. They're kind of a terrorist state within a terrorist state. So when the head was decapitated in the first hour in Iran, that basically unleashed these pit bulls, these terrorists within a terrorist state, to kind of run amok. And as we've seen, they've done that by basically adopting a strategy of chaos, creating tremendous chaos in their neighborhood, and of course by effectively blockading the Strait of Hormuz, they create chaos around the world. I guess what they're aiming to do here is create so much pain around the world that the world will come around to kind of uh, coming up with a ceasefire and some negotiations that would still leave their regime in power. The problem with that, of course, is the President of the United States has declared that he wants unconditional surrender. And it's hard to have unconditional surrender when you don't really have anybody to negotiate with, and anybody that Iran might come up to negotiate with, you might want to behead them too, as a leader that's just not acceptable for negotiating purposes. So it's a mess. What can I say? It is what it is. So on Tuesday of last week, I kind of recognized that it was naive to believe this was going to be short and sweet and everything was going to work just great. And I did point out that this Revolutionary Guard uh, was, I guess it's IRGC. Anyways, I'll deal with the alphabet later, but let's just call them the Revolutionary Guard Corps. Um, is is running wild, and it's hard to see who exactly we're going to negotiate with. So we'll obviously, as long as the strait is effectively closed. And by the way, the price of oil this evening is up something like $20 to $25 a barrel. And I think contributing to that was on Saturday, there was reports that a tanker was hit by a suicide drone launched by the Revolutionary Guard. The other problem that we have with regards to the strait is that a lot of the material is used to make fertilizer go through the strait. And this means that not only are we going to have an immediate surge in oil prices and energy prices and CPIs around the world, but with a lag, we're going to find that there isn't enough fertilizer to meet demand by farmers. Guess what? Just as the planting season is arriving, so this could create some food inflation as sort of the next hit on the inflation side. So this certainly feels like reminds me of the 1970s stagflationary environment, which was no fun at all. We had two energy crises in 73 and 79, again related to the Middle East. The straits weren't closed, but OPEC in 73 cut off oil production and drove prices higher. In 79, it was the Iranian Revolution. And the result was two recessions in that environment, with inflation being increasingly troublesome. And the Fed basically monetized it. And it wasn't until Paul Volcker came in the late 70s and slammed down the monetary brakes that he caused a recession. Oil prices came down, and then the economy improved in the 1980s. So is this going to be the 1970s all over again? I don't think so. Um, but I have kind of changed my subjective probabilities of how I see things playing out. So we had been talking about 60% subjective probability for the roaring 2020s. That's still, we're sticking with that. But what we're changing is we had a Meltup scenario at 20%, and we had a Meltdown scenario at 20%. Forget about the Meltup. I mean, we're leaving it at 5% just in case something surprisingly good happens. Um, and clearly, if we do get some the opening up of the strait, and maybe it turns out that a flotilla of allies provide naval escort service for the tankers, we're still going to have problems with drones, but at least we'll see tankers moving through the straits. Um, so that's a conceivable scenario, but for the here and now, it looks as though we have to reduce the likelihood of a melt up all the way down from 20 to 5%. And we're taking that, what we took out of there, we're putting it into a meltdown scenario. We've all kind of called it the box that has everything that could go wrong is in that meltdown scenario. And so we're raising that to 35%, which includes the possibility of a recession. So it's not our most likely case. Our base case is still that things will work out, that the economy has been remarkably resilient since the beginning of the decade. We've discussed the litany of stress tests of the economy that we've passed. This is the big one. This is without a doubt a big one. And I think, that 35% bucket now is basically what I would call a stagnating economic environment, a stagnating 1970s rerun or redux. And as I said, we have to be realistic about these things, and that's the way it's playing out. The good news is bearishness is likely to increase so rapidly here that again we may overdo it in terms of how bad things are going to get. Let's look at some charts here to kind of give us some guidance and give us some ways to monitor the situation. Let me see if I can find the damn things. I always seem to. Oh, there it is. Okay. Okay, so let's start out with some happy talk. Before the war started, analysts were actually getting more bullish on earnings for 2027, and even 2026 was looking better. And 2026 will increasingly become less relevant, and this thing will converge towards the 2027 level. So forward earnings, all-time record high. I would say that the slope of this thing, and it's a ratio scale. So no, this is not a ratio scale, but the slope of this thing looks like it's actually picking up some. Everything was looking just great, but now I think we face a situation where the market can no longer look forward to two rate cuts by the Fed. The Fed's going to have another inflation problem. The dual mandate is pointing in, we're seeing an increased risk of higher inflation and an increased risk of higher unemployment. So the Fed is kind of stymied from doing anything. I don't think they're going to do a Volcker and conclude that eeny, meeny, miny, mo, we've got to bring inflation down no matter what. So they're probably not going to do anything anytime soon. Steve Moran could vote to cut rates, but he's not. He's going to be the sole dissenter. And then if and when Kevin Warsh becomes chair of the Fed, he's also going to be frustrated with his wish to bring interest rates down. But it's clear that the president of the United States has decided this is the most important issue that he cares about right now, and he's staked a lot on this. The midterm elections are increasingly likely to go against the Republicans because this has clearly become a messy situation. Certainly, it's backfired in any affordability issue. Instead of making things more affordable, it's gone the other way. Frankly, I don't quite know why the president didn't wait until after the midterms, but maybe there was just such an opportunity to take out the leadership of Iran that he kind of jumped at it. But whatever it is, the war started, the war is going on. It's not going to be over in a day or two. Hopefully, it'll be a few weeks, but that's hope. So this picture is going to look less pretty, I think, coming up. and the market obviously will be discounting that. Let's look now at the charts. Well, let's jump over here. This is the quick takes. Um, Got a picture here of uh, what prices may very quickly get to on pumps. Um, but this is the issue is until now I've been a stalwart believer that the economy was so resilient that everything that's hit it since the beginning of the decade wouldn't cause a recession. Now I'm thinking 35%. That's the meltdown scenario. The main issue there is the Strait of Hormuz. The main issue there is that could higher gasoline prices and then subsequently food prices could depress consumer spending. That a weaker stock market could depress spending by the upper wealth, upper income consumers. And I'm not saying that that's the base case. I'm still giving you a happy base case with the roaring 2020s. But 35% is where I see the risk of this causing a recession. And that's kind of consistent with Polymarkets was saying on Friday. You see that we got 34%, but that was on Friday. Uh, on Monday and Tuesday, given what we're seeing overnight in the financial markets, this is going to probably shoot up to something like 50%. I would think we'll be monitoring that closely. As I mentioned before, Trump is risking a lot. If this also creates some issues, obviously, if the Republicans lose the House, and this is what Polly Markets was looking like through Friday, and so you didn't really see that the percentage, the odds of the Democrats winning the House have increased because they're also, look at that. I mean, they're already at 85%, but I won't be surprised if it goes up some more here over the next few days. Um, that just increases the possibility of back to more domestic political chaos with the Democrats in the House. Trump himself has said that they'll impeach him. So suddenly it gets to be a fairly messy outlook. Um, the stock market, the S&P 500 is kind of is rolling over here. It probably will crack through its 200-day moving average here pretty quickly. I mean, it could be a deja vu situation all over again. It could be kind of a repeat scenario here, um, but much will depend on how Trump uh, reacts to the news on the ground and on the Gulf of the Persian Gulf. Then here's the Nasdaq Composite. We're already at the 200 days, so we'll probably crack through that. The bond market is been really remarkably stable. This is the bond yield, and for the past year or so, 12 months or so, as you can see here, it's been somewhere between 4% and 4.25%. Uh, in the recent past, there's a pretty good correlation between the bond yield and the price of oil. And here, the price of oil was going up and broke through its resistance line pretty handily, and the bond yield is still kind of meandering around. Now, tonight it's at 4.2, so there's certainly a potential for that to go up. You would think that bonds might benefit from as a safe haven, um, but right now what we're seeing is the dollar is strong. Even gold's not working. The gold's not working because the price of because the dollar is strong. But I think there's certainly a potential for this bond yield to get up to 4.5, 4.75%. So we didn't expect that this would be the reason why the bond yield would go up, but we have been thinking 4 to 5%, or maybe 4.25 to 4.75% is the right place for the bond market, and getting up to 4.5, 4.75 on this is not exactly the scenario we were anticipating. Um, with regards to go stay home versus go global. On December 7th, I was pretty pleased with myself that we recommended underweighting the Magnificent Seven. So I think that's still a valid recommendation. At the same time, we recommended overweighting the 493 relative to the Magnificent Seven, and that's got suddenly got tricky here because the Magnificent Seven may not be as exposed to oil prices going up. Though on the other hand, they've certainly staked a lot of money on data centers that are very energy intensive. But the good news is the U.S. is energy independent. And while we're not independent of the price effects, we're not going to likely to get a kind of supply disruptions the way we did in the 1970s. So, if you're looking for a big difference between now and the 1970s, I would say the U.S. is not going to have gasoline lines. But then you never know. A lot of it's psychological. My wife tells me that the lines at the gas station around our local BJ's have gotten longer and longer as the price of gasoline's gone up. And that's in our neighborhood here in Long Island. So here in the United States, we on December 7th, we recommended going global and less staying home with the idea that the U.S. was already 65% of the market cap of the global MSCI. So it was already all by itself way overweight. But as you can see, over the past week since the start of the war, the U.S. is down, but it's down less than all these other indicators. The Nikkei, from what I understand tonight, is down 4.5%. South Korea is down a lot. A lot of these emerging economies and even developed economies that are major importers of oil and gas have more issues with what's going on in the Middle East than we do. Let's look at a couple of charts in our situation to give us a little bit of comfort that we're not as vulnerable as other countries are to this mess. So here's a chart of the price of oil going back to the 1970s on a ratio scale. So you can see the kind of increases here. And historically, oil price surges have been coincident with recessions. Obviously, they contributed to recessions or actually caused recessions. And I would say that that was a big part of the 1970s stagflation environment. We had an increase here. That was in 1990. There's a war in the Middle East. There's another one here in, I guess that, the price of oil actually increased here and then it came down with a recession. I don't think that rising oil prices caused the recession of 2008, 2009, but it certainly didn't help. And now we've got this, which doesn't look so bad, but it's up to over 120, so it's spiking up. If we're really, really lucky, this will be more like 2022, where the price of oil did go up because Russia invaded Ukraine. And it did cause a bear market, didn't last that long, was a great buying opportunity, didn't have a recession. And that's kind of what I'm counting on, of a repeat of 2022. But, we're in the fog of war and things could get worse. Here's another chart, price of oil also on a ratio scale versus the S&P 500. And so, rising oil prices cause recessions, cause bear markets. It's hard to, a bear market certainly is conceivable of in this kind of environment if this turns into an outright recession. Here is a few reasons why it might not. Again, we're not likely to have supply disruptions, shortages. Just the price of oil and gas are going to be higher. We are more energy efficient. Here's the energy intensity chart showing how much less intense we are, and that's because We've got more services as a fraction of GDP and less manufacturing, and services tend to be less energy intensive. You could also argue that a digital economy is less energy intensive until the AI phenomenon occurred, and that clearly requires a lot more energy. Um, we've also seen an improvement in gasoline efficiency. This is gasoline usage. This is miles traveled. So we're traveling record miles with gasoline down here, gasoline usage. We have record electricity production. So this is clearly getting an AI boost, and will continue to get that AI boost. I'll skip. Well, this chart, very often when people look at oil supply and demand in the U.S., they look at the red, which is oil field production. What they often miss is the other oil products supplied, and these are natural gas plant liquids plus renewable fuels, and you can see that's a significant number, been a solid increase. So all in all, we're producing something like 24 million barrels a day of crude and other oil product, uh, uh, crude oil like products. And here's, I don't know what that was all about. But this is, again, total supplies of 24 million barrels per day, and total demand usage is around 21 million barrels a day. So obviously we are a net exporter. So, we're far less dependent on oil than we were back then. I should try to get back some data back to the 70s, but even back then we were a major importer of oil. So this is the issue: is are we going to have the 1970s all over again? Stagflation is rising inflation and rising unemployment. It's kind of the worst, one of the worst economic scenarios you can have, short of a deflationary depression, I guess. This is the chart we looked at before. Recession expectations are probably going to surge here. Uh, Oil prices soaring, and gas. This is what gasoline was doing on where are we? Futures, March 6th. So that was taken off. So it's going to continue to take off and get into retail prices pretty quickly in the CPI. Um, and then meanwhile, the labor market will look pretty good in January, looked terrible in February, and some combination of the weather and strikes explain some of it. Maybe we just take the average of the two, and it doesn't look as bad as February, but it's still no home run. The good news is wages were up 0.4%, and the number of hours worked was down only 0.1%. So our earned income proxy for wages and salaries in personal income rose to an all-time record high in where was that? That was in January. No, sorry, February. So that's not so bad, though. That's in nominal terms, and I think even in real terms, it probably was flat. So we've seen that having some impact on retail sales. The core retail sales were up 0.3%, and we're still expecting, as everybody else is, that some of these tax refunds in February, March, and April will boost retail sales. Meanwhile, the really good news, is productivity in the last three quarters of last year was very strong, and should continue to be strong this year. But obviously, if we have a recession, that's not going to be the case. Productivity is output per man hour, and that could be weak in a recession, obviously. Meanwhile, unit labor cost inflation, with productivity being so strong, unit labor cost inflation is very low, and that's helped to bring inflation down. But that was all kind of pre-war stuff. So the Atlanta Fed's GDP model, not terrible. At 2.1% is what the data implies for the first quarter but everything's changed since the start of this war. Well, that's the way I'm seeing things right now. It's a rapidly uh, rapidly changing situation. Again, for those of you who tuned in after I started, this is actually me at 11:36 p.m. on March 8th on Sunday. I've been called to jury duty for Monday, so I asked to postpone it until July, but I'm going to have to show up there to to beg, I guess. But if not, I'll do. I'll. It's the call of duty as a citizen, and I'll do what I need to do. That's it. Thanks for tuning in. We'll have to commiserate together, but I still have the this attitude that periods like this, when bearishness and your stomach kind of gets all churned up, turn out to be buying opportunities. And I think that'll be the case in this situation as well. I mean, it always is. This war will end, and when oil, and in that situation, oil prices will come tumbling down, and maybe a lot of those rebalancing themes that I talked about on December 7th that worked until the war started will work once again. Have a as good a week as you can, and we'll see you next week. Thank you.